Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and this is July 19th, 2016. I'd like to remind you each and every week I am also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and we're having a lot of fun with that newsletter now, I can tell you, with my gold shares and gold share portfolio, predominantly gold shares, gold and silver shares, up over 73% so far this year. Of course, the mining shares themselves are up triple digits in many cases. The whole groups of them are in different segments of my portfolio. So we are having fun. You might want to go to miningstocks.com, check out my work, and take a subscription out. I would just suggest you might find it very worthwhile, especially in this bull market for gold and silver. Also, what is Chen buying? What is Chen selling? You can go to Mining Stocks to sign up for Chen's newsletter as well. Do want to thank all of you for listening, making this one of the more popular shows on the Voice America Business Channel, and encourage you to continue sending along your comments and criticisms, praises, whatever, to questions for Taylor at gmail.com, questions for Taylor at gmail.com. We do want to thank our sponsors for making this show logistically and financially possible: Trimetals Mining, Coral Gold Resources, Aran Resources, Brazil Resources, and Columbus Gold. All companies I'm very proud to have as sponsors. Aran Resources especially has been on a tear, but we'll be talking to the CEOs of all those companies in the weeks to come. I've titled today's show, Learning to Spot Crooks in a Dishonest World. Well, Michael Oliver will be with us, and Michael is certainly no crook. If anybody can ferret out what's actually happening in the markets, it's Michael Oliver. That's why he's here almost every week. Daniel McAdams will be with me from the Ron Paul Institute for Peace and Prosperity. He'll be with me at about a quarter past the hour. And then Richard Mayberry at about a half past the hour will be with me as well. Amir Adnani of Brazil Resources was scheduled to be with me today, but we are postponing his appearance until later in the summer, when he expects to have more significant news to pass along to you. Ben Franklin once was credited with saying, "A penny saved is a penny earned," but when Richard Nixon led America and the entire world off the gold standard for the first time in history, it fostered a culture of theft and dishonesty like never before. More than ever, people now struggle to know right from wrong. How do you know if your investment advisor is honest? How do you know if you're hiring an honest employee or signing a lease with a dishonest or an honest tenant or landlord? Richard Mayberry will tell us of a system that he's devised to help spot crooks, dishonest people, and how to deal with them and save a penny or two in the process. So we're looking forward to what Richard has to say, and I expect Richard will have other things to talk about as well. I want to ask him to talk a little bit about some of the things he wrote in his last newsletter, how Trump could accidentally trigger off a shooting revolution, Clinton's real ideology and how it increases uncertainty, the sovereign debt bomb. Those are some of the topics, if we have time, we'll talk to Richard Mayberry about. But meantime, I'm really pleased to have with me right now Michael Oliver. One of the big things you've talked about recently, I think some people suggest the most important market in the world, the biggest bubble in the world. I think that's what Ron Paul said a couple of weeks ago. That's the T-bond market. Now, we know we've been in a bull market since since about 1982. Bull market in long-dated U.S. Treasuries. It's been a phenomenal bull market. You make huge amounts of money by being long the T-bond. You're suggesting that we're getting close, perhaps, to the end, a blow-off phase. I see that we got up to about 177 something on the T-bond. But we're down a bit today, 172 and 7/32 when I looked at it before we went on the air here. Are you still seeing the possibility of a blow-off here? And then what happens after that, Michael?
Yeah, I think it started close of a month ago. We closed over 170. I'm talking the nearby T-bond futures, of course, what I look at. And they shot up another 7.5 points or so after that. Pull back here to the 171s, now 172. This pullback, as nasty as it seems on a short-term basis, I don't think it's the end of the blow-off. I think it's just a very sharp pullback toward where the blow-off was initiated, which is crossing 170. So I think there's support down there. Forgetting that, I'm not encouraging people to participate in the upside or the blow-off. That's a very dangerous thing. I mean, it might be joyous for a couple months, but when it's over, it's dark, very dark, very big. And so I'm looking at the blow-off as the termination of the bull market and the implosion that will follow. This is technically argued. You could fundamentally argue it, but I argue it technically. Based on price and momentum, they both say the same story. They say once this party is over, and I suspect we're going to get long yields below 2%. They're just above 2 right now. I'm talking 30-year. And once that's over, it wouldn't shock me that the first down wave in price immediately jacks rates up to about 4%.
Oh, my goodness.
Which is a shock. I mean, that's not a high rate, but it's a shock relative to what people are expecting and have priced into their various and sundry portfolios. And at that point, I think one of the torpedoes that will hit the bond market is already underway, has already been fired. I think it's a commodity torpedo, and the gold is leading the way, as silver, and then other markets in various ways. An upturn. And where you can turn around and say, my goodness, inflation, as it's popularly measured. Instead of in the growth in the money units, it's a rise in commodity prices, which is another way to express it. I think that's underway. But it's not publicly acknowledged yet. In other words, most analysts and technicians don't quite see what I think I see, which is this is a real turn in commodities as an asset category. It's a preference turn for investors, where investors are getting bored with stocks, scared by stocks, holding their nose while they own their stocks, and looking for alternatives. And sophisticated investors have learned over the last decades that commodities are an alternative. They've done it before. From 2000 to 2011, if you own commodities, you did very well, handsomely, versus stocks, which did nothing. So I think that's underway as well. But so these various tectonic plates are shifting, and I think that the finality is that T-bond blow-off. That is the most lethal thing a market can ever do at the end of an extended move, is to go vertical.
Well, Michael,
it's over.
You mentioned that there's not much public acknowledgement yet of inflationary pressures, but I can't help but comment that Alan Greenspan saw that a few weeks ago. I think the first day or so of this month, when he was with Tom Keene on Bloomberg, and he was talking about the very strong correlation between M2 and the popular version of inflation, and also he was mentioning that whenever countries get themselves into this kind of condition that we've gotten ourselves into, the outcome has ultimately always been inflation. So there's one person that I think is seeing that, and I'm sure there's others, but it's not popular yet. So that could really, so people are not going to be willing to lend their money out there if they're deeply underwater, I guess.
Yeah, that's exactly right. I think that at that point they get smacked in the face by rising prices and the low return they're getting on their T-bonds, and et cetera. And it's gotten narrow because, a few years ago, or a year and a half ago, there was an alternative in between stocks and bonds, and that was high-yield debt. But high-yield debt scared folks. It had a big drop in price, and now it's rebounded some. But the point is, though, it shook them out of that category to where they were stuck with two alternatives. Let's go buy stocks, which are doing nothing in the U.S., it is, or let's buy bonds. And, of course, the thing to have done was buy bonds, even last Christmas, into last year. We were at 153 in the T-bond futures. They're now 172. Compare that to what the S&P has done this year. There's no comparison.
True.
So the real risk there is for the pension funds around the country that are underwater, demographically speaking. They're on a wrong trajectory. They don't have any alternatives. CalPERS just made 0.6% last year.
Yeah.
They need to be making 7.5%. Yeah. They weren't long T-bonds. They were long stocks. Okay, God forbid they turn around and buy T-bonds now.
All right, so Michael, you could see the handwriting on the wall in a way, because that when you have thousands and thousands of people that aren't going to have their retirement money in place, the government's going to put pressure. There's going to be all kinds of pressure on the Fed to print. This comes along at the same time that your commodity prices are rising. And, you could see this thing really turning around. And one thing I know is that when inflation turns and the psychology changes, it can happen very rapidly. So you're saying also that with the blow-off in the bond market, you could see a reversal very, very rapidly, I guess. That's why you think it's very dangerous to be on the long side of the T-bond.
Yeah, as much fun as it might be, easy money real fast, but when that's over, it's a tombstone. that kind of price action. And what should follow is a very rapid collapse in the bond market. Not an easy pullback, but a rapid collapse, at least down to up to that 4% yield area before you find any resistance to further rise. Yeah.
I just can't imagine what that's going to do to the equity markets, and I know that you're bearish on the equity markets. The S&Ps continue to perform well, relatively well, although if you look at it over across the year, I think they're only up 4 or 5%, something like that.
Mm-hmm.
Since the first
indexes aren't.
Yeah, and most all the other indexes aren't. So, but I do want to ask you now, we're just basically out of time, but I want to ask you, gold and gold shares, you're still very bullish on gold, I guess, and you were talking about 1400s, low 1400s, mid 1500s.
High 1400s. I still
high 1400s to low 1500s as the first major resistance point. You're still seeing that?
Yes, I still see it. On the GDX, I have a little bit of difference there. It saw 31 recently, I think, before it goes into a congestion problem area, and I don't look for anything sharp, but I still think it's going to 39, by the way, is 32 or higher, and we haven't been there yet. Right now we're just under 30, we're 29-something. So I think there's another $2-3 upside here in this particular surge. Also, silver is vastly now outperforming gold. The ratio has changed dramatically, about 20% in the last several months. So silver is a place to be. Right now, silver's just under 20. I think its next stumble point might be 23, but you do the percent on that and then add that same percent to gold, and you're talking upper 1400s. So I'm looking at 23 as the next target area for silver, not a final, but just the next target area.
Okay, then we might see some sort of a pullback for both the precious metals after they reach that
period or something like that. Yeah. Mm-hmm.
Right. Okay. All right. Well, thanks again, Michael, for being with us. Always good to hear your opinions, and your opinions mean a lot because you've been so right on so many of these markets that I've been watching. So thanks so much for sharing your time.
Sure. And your listeners can always get samples if they like by going to the site. That'd be fine.
Yes, thanks. And that's OliverMSA.com. OliverMSA.com. Thanks for bringing that up, Michael. Thanks so much for being with us, and we'll look to do it again next week, hopefully.
Bye-bye.